welcome to both of you. Thank you for joining us today. So with me are Vincent Mortier, Amundi's Group Chief Investment Officer, and Anna Rosenberg. Anna, you are Head of Geopolitics at the Amundi Investment Institute. And of course, our audience, no doubt, is very keen to hear how everything we've heard so far will be impacting markets and investors. So Anna, as Head of Geopolitics, that's your key topic, you help investors navigate geopolitical risk, or risks, because there are many, which have certainly been a real preoccupation for investors lately. So do you expect the topic to remain top of mind for investors out there?
Well, frankly, after everything we've heard so far, yes. Our quantitative and qualitative analysis suggests that geopolitical risks are likely to rise for the remainder of this decade. And there are various reasons for this. Firstly, since the Russia-Ukraine war and since the Hamas attack, we see more countries involved in driving higher levels of geopolitical risk. And like in any relationship, the more actors you have involved, it's more difficult to solve them, right? Then we have protectionism, tariffs, trade wars, export controls. All of that means economic friction. And history tells us when there are periods of economic friction, that is also more likely to result in hot wars. Any incoming US administration is going to preside over worsening ties with China. And we've already heard a lot about other countries starting to join forces against the US. So all in all, we also have two other factors which are important. Clearly, climate change is one, another driver of risk, but also technology, such as AI, for example, on the power they have for political misinformation. So if you add all of these layers of risks, I think it's pretty obvious to say that geopolitical risk will remain high and top of mind for investors.
Thank you, Anna. Now, Vincent, you speak to investors on a daily basis and you travel all around the world to meet them. In fact, you've just returned from the US and Asia. So how do investors look at geopolitics today?
So yes, for sure, for investors, geopolitics is central, but with a different perspective depending on where they are. That is normal. Most geopolitical risks are perceived generally as temporary, with two notable exceptions, which are first armed conflicts and second the US-China rivalry. So armed conflicts for sure are here to stay, and they can spread. So something now each investor is reflecting. So in terms of allocation, it means to have more safe haven assets, for sure, to have more commodities as well, and not only oil and gas, but all kinds of commodities, and as well, naturally, to have to reinforce the defense sector allocation, which is becoming quite an ESG theme as well, finally. Secondly, the US-China rivalry or conflict, or whatever you want to call it, is long-lasting, and we think will worsen. And allocation consequences have been pretty simple or straightforward. So meaning many investors in the West dumping Chinese assets, it's very simply. The opposite, so meaning Chinese investors selling off US assets has been less obvious, even though we have seen some more and more Chinese investors not reinvesting the maturing money coming from treasuries.
So Anna, Vincent has given us a few pointers here, but how is Amundi accounting for geopolitics in the investment process?
Sure, so we closely monitor geopolitical developments and help our portfolio managers make a difference between what is noise and what they really have to focus on. We develop scenarios and assess likelihoods so they can reflect that in their portfolios as well. And importantly, we also factor geopolitics into macroeconomic forecasts. For example, what could the potential Houthi activity in the Red Sea mean for inflation? What does growing protectionism and defense spending mean for US fiscal realities? But importantly, we also take geopolitics as a lens to spot opportunities. Because despite all the risks, there are actually a lot of winners on the country level, on the company level, on the sector level, on an asset class level. So, for example, we have created a ranking that positions countries that are really making the most of the geopolitical realignment underway. And, for example, South Korea and Indonesia are positioned very high in that ranking. So, in a nutshell, we are incorporating geopolitics by helping them stay on top of risks. For that, we have also developed a new data tool. It's called a Geopolitical Sentiment Tracker, which flags risks and which the portfolio managers can also build into their models. And then, as I said, it's also about developing trade ideas based on risks and opportunities. So when it comes to risks, for example, it's about shorting currencies when they materialize. When it comes to opportunities, for example, the lifting of sanctions is an important driver of asset prices.
Well, there's a very clear plan in place, of course, Vincent. As Europe's largest investor, I was wondering if you could maybe go back to what you mentioned previously, this rivalry between US and China and how it's affecting your investment process. What are the main consequences?
Yeah, so that's a tricky question because there are multiple time horizons to consider. What we have seen is one of the most popular strategies, as I mentioned, has been to divest China and to look for a proxy, and in particular for Western companies who are active in China, having big business in China. We believe it's a bad strategy. It's a loss-making one because actually in China, more and more Chinese companies are competing and gaining market shares against Western ones. And it's a result of a plan by the Chinese authorities to develop higher quality growth onshore to start with. And as a result, the Western companies active in China has been challenged quite hard. So in fact, our strategy has been more the opposite, to underweight actually these companies, which are due for a kind of long-lasting pain. Other strategy which has been very popular has been to say Japan plus India is a proxy for China. It has been a strategy working very well for the last 2 years. Now we believe in terms of valuations, this strategy does not have much juice left on a relative basis. So it has been a smart one that we actually followed at Amundi. But I would say now it maybe time to take profit relatively and to go back to China. And on a more strategic allocation standpoint, we continue to believe that China deserves a specific allocation. It's a one allocation pillar, like any other country, actually. We even think that medium-long term, it deserves an overweight compared to other countries. But more on the broad A-share market, because in fact, what we see on the ground is innovation, and it's really coming from the private sector, from the broad market, not from state-owned enterprises and not really from mega cap, but more for this broad A-share. So that's why we are more overweight this market.
And of course, we're going to have many conversations around innovation and technology here over the course of the next 2 days. Many thanks to you, our Amundi experts, for your insights today. Thank you very much. Vincent Mortier and Anna Rosenberg, thank you.